The market isn't collapsing because businesses are broken. It's falling apart because of a convergence of forces. When you glance at your portfolio right now, it probably resembles a disaster zone. Red numbers everywhere, fear flooding the headlines. But there's something essential you need to grasp at this very moment. Most people are watching their wealth evaporate because they can't distinguish between a failing business and a turbulent market. These are fundamentally different situations. Right now, four massive blows are hammering the economy simultaneously. It feels like taking punches from every direction at once. First, there's an overwhelming AI panic spreading. Second, major players are cashing out their gains. Third, China is restricting metal exports. And fourth, the US dollar is encountering serious challenges. When these four forces collide at the exact same time, rational thinking disappears from the market. Logic evaporates. The market simply reacts with pure emotion. It panics without thinking. Every significant downturn appears like the apocalypse approaching. But when you actually examine the underlying data, something becomes clear. This isn't about individual companies failing. Microsoft didn't suddenly lose its ability to create software. Nvidia didn't stop producing chips overnight. This is about market positioning, nothing more. We need to distinguish between irrational fear and genuine opportunity. I'm about to reveal exactly why major tech companies are being punished so severely, where intelligent money is quietly repositioning itself, and how you can position yourself to survive this storm. Stay with me because I've discovered three specific stocks that are completely flying under everyone's radar right now. Two of them trade under $100. You've probably never heard their names, but their charts tell an incredible story. Before we get there, though, we need to address your mindset. Before your finger hits that sell button, before panic takes control, you need to ask yourself three critical questions. This is your filter. Question 1. Is this a company-specific problem? Did leadership collapse? Did they lose a major lawsuit? Question 2. Is this an industry-wide issue? Is the entire sector struggling together? Or question 3. Is this a broader market event affecting everything? Right now, we're experiencing a market-wide event. The entire ocean has turned violent. That doesn't mean your vessel is damaged. It simply means the waves are enormous. Let's examine the first wave hitting us, the AI panic. Software companies are being absolutely demolished. A few weeks back, warning signs appeared for stocks like Microsoft, Adobe, and ServiceNow. Why the sudden fear? Because there's a rumor circulating, a ghost story haunting traders. There's this notion that a new AI model from a company called Anthropic will emerge and completely obliterate the competition. The market is behaving as if this single piece of technology will make massive corporations like Salesforce and Oracle obsolete overnight. Does that sound remotely realistic to you? Probably not, but we've watched this exact movie before. Remember DeepSeek? That Chinese company appeared, and everyone screamed that Nvidia was finished. The stock crashed hard, panic selling erupted everywhere. And what actually happened? We discovered DeepSeek was using Nvidia's technology the entire time. Wall Street has this terrible habit. They price in hypothetical scenarios before examining actual reality. They price in disruption before it materializes. It's insane, but that's how this game operates. They fire first and investigate later. But you don't have the privilege of being that emotional. You need to remain cold and analytical. Then there's the second wave crashing into us, profit taking. Think about the past 3 years. The market has been on an extraordinary run. Stocks like Nvidia dropped 40%, then reversed direction and skyrocketed. Major investors are sitting on mountains of cash, and now they're collecting their winnings. Taking profits is a completely normal part of this cycle, and don't ignore the calendar. We're moving through an election cycle. Historically, when you study the patterns, midterm election years create turbulence. Typically, markets decline during these periods. The average drop sits around 18%. That stings badly. Nobody enjoys watching their account shrink by 18%. But here's the critical part everyone misses. After that drop, the average recovery bounce is 37%. Think carefully about that mathematics. You must endure the 18% decline to qualify for the 37% recovery. It's the toll you pay to cross the bridge to wealth. What does this actually mean for your situation? It doesn't mean you should convert everything to cash. It doesn't mean you should liquidate your positions and hide in fear. It means you face exactly two choices. You can accumulate quality assets during these dips while everyone else is crying, or you can strategically reposition your capital toward where the market is actually heading. Selling simply because you see red numbers isn't a strategy. It's an emotional reaction, and emotional reactions destroy wealth. Conviction creates wealth. If you sell right now, you're committing a fatal error. Here's the brutal mathematics. If you miss just the 10 best trading days in any market cycle, your returns get slashed in half. That's the reality. Just 10 days determine whether you retire wealthy or whether you continue working until you physically can't anymore. And if you're sitting on the sidelines paralyzed by fear, you're guaranteed to miss those explosive days. You'll miss the recovery bounce entirely. While everyone else is panicking and watching big tech stocks get hammered, intelligent money is moving quietly and deliberately. They're rotating into companies with genuine pricing power, companies that actually execute flawlessly. This is where disciplined capital flows during chaos. But before I reveal this first stock trading under $100, you need to understand the bigger picture developing. Look at Amazon's recent performance. Look at Palantir. Look at Microsoft. These companies are posting phenomenal financial results. They're generating profits at an incredible pace. And how does the market respond? It punishes them savagely. Amazon absolutely crushed earnings expectations, but the stock dropped anyway. Why would that happen? Because of capital expenditures. Because they're investing heavily to build the future. Stop listening to all the noise out there. Stop buying into this AI bubble narrative. Think about it with pure logic. Do you honestly believe Amazon would spend billions of dollars if they believed this was a bubble? Do you think Mark Zuckerberg at Meta is setting cash on fire for entertainment? Do you think Microsoft is deploying hundreds of billions on a random impulse? Absolutely not. Wealthy people don't accumulate wealth by making stupid decisions. They grow their fortunes by intelligently growing their businesses. That's exactly what capital expenditure represents. It's strategic investment, not wasteful loss. Even Nvidia's CEO appears confused by current market behavior. He's watching software stocks plunge 30%, hitting 52-week lows, and shaking his head in disbelief. The market acts like this makes sense. It doesn't. The market is behaving completely irrationally right now. It's acting like an emotional child throwing a tantrum. The market is never technically wrong in the absolute sense, but it frequently behaves insanely. So you're facing a real problem at this moment. Your portfolio is heavily weighted toward technology, and technology is getting absolutely beaten down. You're searching for stability. You're looking for a stock that climbs even when economic conditions turn weird. I found a stock doing exactly that. It's up significantly this year, but nobody's talking about it. I'm going to give you the ticker symbol in just a moment, but first you need to understand why this specific sector is essentially bulletproof. The ticker symbol is Golf, GF. This is a small cap company, and the chart pattern is genuinely beautiful. It's up 24% year to date. It's up 142% over the last 5 years. This isn't hype or speculation. This isn't AI smoke and mirrors. This represents real demand from real paying customers. What does this company actually do? It's right there in the name. They form the foundation of the entire golf ecosystem. They own the balls, the clubs, the equipment, the apparel. If you play golf seriously, you're handing this company your money. Period. This is why I love fundamental investing. This business doesn't care about the Federal Reserve's interest rate decisions. It doesn't care about AI disruption narratives. It doesn't need ChatGPT to sell premium drivers. It just needs the same Wall Street executives selling your tech stocks to play 18 holes every weekend. Golf isn't a hobby for these people. It's a deeply ingrained habit. It's practically an addiction. Golf isn't discretionary spending for this demographic. It's mandatory spending. If the Fed turns hawkish, people still golf. If the economy contracts, people still golf. In fact, if conditions deteriorate severely, they might cancel the expensive European family vacation. But they absolutely will not skip their Saturday morning tea time. They might even choose a cheaper vacation destination near a golf course. Here's the fundamental truth. Experience-based spending proves stronger than technology spending during economic contractions. Let me repeat that because it's critically important. When people feel scared financially, they stop buying gadgets and devices. They don't stop buying experiences. They don't stop living their actual lives. And this golf company possesses something most businesses dream about achieving. They have genuine brand authority. If they raise the price of their golf balls, customers don't leave. They don't go buy cheap generic alternatives. Why not? Because performance matters intensely in golf. You don't compromise your golf game just to save $2. The wealthier you become and the older you get, the more you golf. That's a locked-in customer base. That's real pricing power. We're not talking about Starbucks pricing power where I can just make coffee at home. You cannot manufacture a professional golf ball at home. This company isn't barely surviving quarter to quarter. It's actively thriving. It maintains a fortress balance sheet. It has substantial cash reserves. And in a market environment like this, cash is absolute king. This is the beauty of a company like Golf. It doesn't need to beg for capital. It doesn't need a new IPO. It doesn't need to sell debt to predatory lenders on Wall Street. It has its own self-sustaining engine. It has a recurring revenue model that prints money consistently. That means you don't have to worry about emergency share dilution where your ownership suddenly becomes worth less. You don't have to worry about desperate loan agreements. When market conditions tighten, most companies play pure defense. They curl up and wait. But Golf plays offense. Why? Because when wealthy executives close their laptops, when hedge fund managers step away from the panic, and when quantitative traders shut down their algorithms, where do they go? They go directly to the golf course. In volatile markets, capital rotates actively. Money is alive and intelligent. It runs away from stories and hype, and it runs toward proven execution. It seeks safety and predictability. Golf checks every single box. It's consistently profitable. It generates substantial cash flow. It has global demand. And it doesn't care whatsoever about AI disruption. That's exactly why it's up double digits this year while your tech stocks are bleeding out. That's why it's up triple digits over 5 years. But listen carefully. I have two more stocks for you. And trust me, the next one is even more surprising than the first. Stay with me because we need to address the elephant in the room. We need to talk about China's role in all this. This is the silent killer affecting your portfolio right now. People think China is just scaring markets with threats. No, they're controlling the fundamental inputs. We're talking about rare earth minerals. We're talking about silver and critical materials. We're talking about the raw materials that literally build the modern world. China isn't just exporting products anymore. They're strategically positioning themselves. They're building alliances designed to counter American economic dominance. They want the yuan to become the world reserve currency. They want to knock the dollar off its throne. These metals aren't just commodities to them. They're strategic weapons in economic warfare. And this leads directly to the fourth massive hit on our list, the dollar itself. The US dollar is losing its strength steadily. Countries are selling off US debt like it's expired and worthless. They're buying gold instead as a safe haven. We're walking into a completely new regime, a new set of rules governing the global economy. Now, this sounds absolutely terrifying. I know it sounds like the sky is falling. But here's the secret truth. Uncertainty doesn't crash markets by itself. It just pauses them. It makes them hold their breath and wait. The crash happens inside your personal account when you panic and act emotionally. Every time you sell because fear takes over, you lock in permanent losses. You tell yourself, I'll exit now and re-enter later when things calm down. But you never do. You miss the opportunity completely. Think back to last year's action. Nvidia dropped 30%. It fell all the way down to $83. People declared it was finished. Then what actually happened? It ran straight up to $200. Palantir touched $7 last year. Everyone said it was worthless trash. Then it ran to $21. We watched amazing quality companies get absolutely torched, down 30, 40, 50% in April. Everyone was screaming fire and running, but by May, they were rallying hard. By June, they were soaring. By October, all-time highs everywhere. This time is exactly the same. Do not listen to people who claim this time is somehow different. It's never different. The market has no new tricks in its playbook. It just wears a different mask each cycle. Veterans who have been trading for 10 or 20 years don't panic during these periods. They look at the chart patterns and say calmly, I've seen this exact episode before. I'm not claiming to be a guru. I don't possess a crystal ball predicting the future, but I have watched this movie play out repeatedly. When Meta was trading at $89, people told me directly, that looks way too risky. Today it's over $600. When Netflix crashed to $170 in 2022, people declared streaming was completely dead. Now look at the price. The pressure feels incredibly tight right now. I know it does. It feels heavy on your chest. You check your phone and your stomach drops instantly, but you have to zoom out and see the bigger picture. We have been in this exact situation before, and we will absolutely be here again. The question isn't whether the market will recover. The question is whether you'll still own the winning stocks when recovery happens. So we've covered the fear psychology. We've covered the first stock. But now we need to examine where else intelligent money is hiding because there's another sector quietly making people wealthy while tech burns. And this next stock, nobody sees it coming. Your emotions are screaming at you to sell everything. Your brain is screaming to get out immediately. That's your nervous system completely frying under stress. I told my team last night directly, when the market closes, you need to close the laptop. Turn off the iPhone completely. Go take a hot bath. Take some magnesium. You need to physically calm your body down because you're reacting to pure fear. But this isn't real existential fear. This is forced selling pressure. The market is twisting your arm violently, trying to make you tap out. And if you tap out right now, you lose everything. You hand over your wealth to someone else who stayed calm. Don't let the headlines fool you for a second. They're designed purely for clicks, not for your bank account growth. They sell panic for profit. I sell perspective and clarity. The cycle never fundamentally changes. The market doesn't reward patience loudly with immediate feedback. It doesn't give you a gold star today for good behavior. It rewards patience later in the cycle. It pays you in quiet, massive gains years down the road. You want to become the person who says confidently, I bought Palantir when it was $13. I bought Nvidia when it was 80. I remember buying Nvidia on a plane from Paris when it was tanking hard. Everyone thought I was completely crazy. Now they call me lucky. It wasn't luck, it was understanding infrastructure fundamentals. And infrastructure behaves very differently from technology stocks. It doesn't move fast and explosive, it moves heavy and steady. This brings me to the second stock I promised you. And full disclosure, I used to work for these guys back in the day in Lake Charles. I've seen this beast operate from the inside. The company is Fluor, ticker symbol FLR. Fluor doesn't sell ideas or dreams. They build the things that civilization needs to actually function. They build energy infrastructure, they build LNG facilities, they build data centers, they build defense projects for the government. When I was working with them, we were constructing massive LNG facilities. These projects are funded before the stock market even knows they exist. We're talking about contracts worth hundreds of millions of dollars. These aren't optional projects. You don't just cancel a $1 billion power plant because an inflation report came in hot. Right now, Fluor is up 12% this year. It's up 159% over the last 5 years. This is real growth based on signed contracts, not invisible forecasts. Fluor doesn't care about quarterly market sentiment. They operate on multi-year project timelines. Once a project is approved, it becomes a freight train. It doesn't stop for inflation data. It doesn't stop for unemployment numbers. It doesn't stop for a housing crash. It just keeps rolling forward. And here's their secret weapon: cash flow. In a downturn, cash is oxygen. If you run out of cash, you die. Fluor has a strategic cash advantage. They have free cash flow strength. They don't face forced dilution. They don't need to beg banks for emergency loans. They absorb volatility while other companies break apart. So while the market is punishing the story stocks, it's rewarding the builder stocks. These companies survive the winter and dominate the summer. When money gets sucked out of the market, governments still build bridges. When money floods back in, governments still build power plants. I want you to sleep well at night. I don't want you staring at the ceiling wondering if your portfolio went to zero. And remember, I'm not a financial advisor. This isn't financial advice. It's education. I want you to stop obsessing over the same 5 tech stocks repeatedly. Branch out strategically. Fluor operates globally, but it doesn't rely on consumer spending. If you stop buying lattes, Fluor doesn't care. Their customers are governments, energy giants, the people who run the world. Their revenue is tied to national security and infrastructure cycles, not your mood. When markets panic, they sell stories. But governments don't stop building. That's why infrastructure quietly outperforms during chaos. So we have golf for consumer habit spending. We have Fluor for industrial muscle. But I have one last stock for you, and I have to warn you, this one is boring. And that's exactly the point. The ticker is WTS, Watts Water Technologies. This is boring. And boring pays consistently. Boring keeps writing checks when excitement collapses. In a bull market, you look for excitement. You look for the next Nvidia. You look for the next Google. You chase the shiny object. But in a market like this, you don't want shiny. You want bulletproof. I'm going to break down exactly why this boring stock is about to become your favorite asset. But you have to understand one thing first. Water is the new gold. You're addicted to the hype. You're looking for the next Palantir. You're hunting for the next super microcomputer. You want the stocks that explode overnight. And while you're chasing fireworks, you're missing the quiet giants that are outperforming the big names year after year after year. This is Watts Water Technologies, WTS. They make the systems that control water flow, water pressure, and safety. We're talking about plumbing infrastructure, commercial skyscrapers, residential homes, and industrial factories. This company does it all. Here's the fundamental rule. If water moves through a building, this company is involved. Think about that for a second. Look around you. Think of every building you've entered in the last week. Every office, every store, every house, they all have water moving through them. And WTS owns that flow. Nobody delays water safety. Nobody says, let's skip the pressure control this year. Nobody ignores plumbing regulations. You literally can't. The government won't let you open the doors. This creates inelastic demand. That means no matter what the price is, people have to buy it. You can't negotiate with a leaking pipe. You can't negotiate with a regulator. You just pay the bill. And because pipes break and valves wear out, you have a recurring replacement cycle that never ends. Regulation drives their sales automatically. They don't need a marketing team. They have the law. This company is playing the long game. They're up 12% year to date. They're up 155% in the last 5 years. I really went into the lab and found some incredible opportunities for you today. This isn't luck. This is deep research. Their balance sheet is disciplined. WTS doesn't chase growth at all costs like these tech startups. They protect their margins. They manage costs. They manage chaos. And then they simply return that capital to you, the shareholder. They stay profitable. These are the stocks you buy so you can turn off your phone and sleep peacefully. You don't need to check the ticker every 5 minutes. Institutions trust them because they're boring. They don't have drama. They don't have scandals. They just have predictable cash flow and elite execution. While everyone is screaming about AI and chips, companies like this are quietly making millionaires. They don't get the television coverage because water pressure valves aren't sexy. But you know what is sexy? Profit. So look at the pattern I just gave you. First, golf gives us experience spending and pricing power. Second, floor gives us infrastructure and contracted cash flow. Third, WTS gives us necessity and execution discipline. None of them depends on AI narratives. None of them has narrative risk. None of them requires you to believe in some vision. No tariff risk, no deep-seek rumors, no massive capex spending uncertainty. It's just raw demand outperforming the hype. When the market punishes the storytellers, it rewards the builders. It rewards boredom. These are the opportunities hiding in plain sight while everyone else is panicking. If you found value in this breakdown, make sure you check out more content on XCane Edge for deeper analysis. The market rewards those who stay calm and think clearly during chaos.